Anurag, what bright spots are you expecting from the upcoming earnings season for big tech?
Yeah, thanks, Roger. So, from our side, I think it's going to be a very tough earnings season for big tech, probably for the first time in several years, and largely as a factor of, economic activity slowing down. People are holding back on discretionary IT spending. They're also, pull back in PC sales, smartphone sales. So overall, probably I would say this was one of those quarters that would be the low point, in our space with, Amazon is cloud growth slowing down, Microsoft's cloud growth slowing down, as well as infrastructure sales as well for the case of Microsoft. And in the case of Apple, we are expecting a slowdown in Mac sales. We are expecting a slowdown in services sales. So those are kind of the big, companies that we are focused on right now. As I said, this is probably one of the first ones that we will see where it's weak quarterly earnings.
And Rob, turning to you, could you talk about the impact in the quarter from rising rates on both credit quality and borrowing costs?
Hey, sure, Roger. It's a little bit different than Anurag's point of view. From my perspective, if I was carving the Mount Rushmore of credits, Amazon, Apple, and Microsoft would be on there. Costs are rising all across the board, including interest rates and borrowing costs, but it's not meaningful. And in fact, I think financial flexibility is going to start being rebuilt in this quarter, and it's going to enable names like Apple and Amazon to potentially announce meaningfully larger share repurchase programs. And I think the intent of use of capital will continue to go and focus on shareholders as that financial flexibility builds throughout the year.